Hi, everyone. My name is Ellie, and we are very happy to have you here at 7 Pillars for a Successful Sales Tax Strategy Part 2. After this webinar, we are going to go into each of these pillars and break them down, but today will be a high-level overview, so thank you so much for joining us. And before we get started, why don't we go over a few housekeeping items, and we'll jump right in here. So first and foremost, if you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. You will need to answer the poll questions as they pop up on your screen. If you have any issues with that, please just let me know. I am more than happy to help you sort that out. And you will need to answer the survey at the end of this webinar. It will pop up for you as you are exiting. It will also be emailed to you in 24 hours. Both are fine, but you have to do both of those things again in order to receive that CPE credit. A couple other things to take note of here. If you have questions as we're going along, please reach out and ask those questions. We are going to do our best to address them at the end of this webinar or follow up with you via email. You can use the Q&A button in the middle of your screen to ask those questions again, and we're going to do our best to address them. We also will be linking today's slides once we get the ball rolling in the chat box. We also have uploaded them to Zoom, and they will be emailed to you in 24 hours. So there's a few ways to get your hands on the slides and the handouts. A quick announcement here about our webinars. We are starting to offer pre-recorded webinars with CPE credit. We've had those on YouTube for a long time. They will now be offering CPE credit, and we've had a little bit of a hang up sorting out the pricing and membership platform, but it should be up really soon. And you can also access those pre-recorded webinars via our Salt Vault. They're included in a package there, which has a lot of, you can go to this link and learn more. It has this list of things as well, or you can just pay for those pre-recorded webinars. And let's do a quick introduction for our firm and founder. So Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, and like our name states, more. So if you have questions about our services, please reach out and ask. We would love to work with you, and we'd love to hear from you. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded, and he has helped thousands of companies of all sizes and in all industries, and is especially well-known for his work in the e-commerce industry. And Mike, it's time for you to take it away.
All right. Thank you very much, Ellie. That's a wonderful introduction. We have a lot to cover today. This is part 2 of the 7 pillars of a successful sales tax strategy. And for those of you who have not heard this before, these are the 7 areas that when we're doing audit defense, most audit defenses tie back, any of the problems in the audits tie back to one of these 7 pillars. So today we're going to cover some action items from the last webinar. We're going to go over certificates. We're going to go over returns and registrations. We have them lumped together here. We're going to talk about audits a little bit, and then we're going to open it up to questions. Before we do, Ellie, why don't we go to the first polling question?
Absolutely, and that should be up on everyone's screen. The question is, which of the following did we say yesterday? Which of the following did we say a couple weeks ago? And your options are: it all starts with Nexus, it all starts with taxability, Nexus is all that matters, and other. And Mike, most people are right out the gate getting this one correct. Let's give everyone a few more seconds here. You do have to answer these poll questions in order to receive CPE credit. So Mike, I will close this out and let's move forward.
Okay, and what we have said is it all starts with Nexus. And the reason why we say that is because if you don't have this link or connection with a state that we call Nexus, then the state cannot require you to do anything. So no Nexus is no problems. That's why we say it all starts with Nexus. Now, here's some action items from part one. Number one, we talked about Nexus. We said that it's really just a fancy word that means link or connection. And what companies need to do, what their accountants need to do, is help these companies determine what their Nexus footprint is. Because if you have this link or connection with the state, then you may have to take additional steps. If you don't have this link or connection, then you probably don't need to do anything else. Second step is determine if what you sell is taxable. You have to have a process for applying that taxability. So let's go back and talk about software a little bit. A lot of software companies out there say that their software is going to tell you wherever you have Nexus, and it's a good red flag. However, if you're relying solely on software, you're probably going to be getting registered in too many states because the software just doesn't get granular enough to be able to tell you where you actually have Nexus. Shopify, perfect example. We have a client who's selling dietary supplements. Sorry, I had a brain freeze there in a minute. And they're not taxable in a number of states. And they came to us the other day and said, hey, Shopify is telling us we need to get registered. And I looked at the language that Shopify was saying, and it was definitive. It didn't leave any room for error there. It said you are out of compliance or something like that. But they didn't have a responsibility to get registered in these states because what they're selling was not taxable. So you cannot rely just on software. It's a good red alert. It will make you focus on where you may have potential issues, but you're going to be getting registered in too many states, and once in a while, not enough states, because it just doesn't have enough of your specific facts. Taxability. Software is not going to be able to help you determine whether what you sell is taxable or not. You have to set it up in order to do that. And you have to know how something is taxed in order to be able to set it up correctly within the software company. So the initial determination, what's going to help you match your products and services with their codes, the software is not going to help you do that. Once you get it mapped correctly, most of the software does a pretty good job of staying on top of it and tracking all of the changes. So that is something that software is good at. And then rates. You got to have a reliable source for rates. And we have some clients who have very few invoices per month, but they're tremendous invoices, a couple $1 million. And if that's your case, then you can call the states directly. You can use one of these free rate services online, and they will give you the rate for that specific location. But if you have hundreds or thousands or tens of thousands of transactions, this is really something that you can't do manually. It's something that software excels at, is helping you determine the rates in real time. And then we talked about use tax, and you have to have a use tax accrual process in place. Use tax is either the number one or number two cause for large assessments. We're going to talk about certificates today. That's the other one. Just because someone doesn't charge you tax doesn't mean it's tax-free. It means you're supposed to self-assess and remit it to the state directly. So again, software can be a great tool here. But some of these software companies say, hey, all you got to do is sign up for our software and it's taken care of. And that's just not true. Most of us don't have our accounting system set up for this to happen. So there's got to be what I call a blended approach. You can make whoever's doing the use tax accruals, you can make their life easier by utilizing software, but you can't rely on software alone. All right, so let's move on to exemption certificates. And once you're registered, you don't have an option. You must either collect the sales tax or collect a properly completed certificate in lieu of collecting the tax, which is acceptable to the delivery state. Now, that delivery state's important. If we go back to rates, which we talked about, sales are generally sourced to wherever the property is delivered. So especially when we're talking about tangible personal property and talking about interstate shipments where they're crossing state lines. So it's going to be the delivery state. So if that's the state's rate that we're not going to charge, then the certificate should be acceptable to that state. Now, there are whole sorts of different types of certificates out there. Three of the most common that we run across all of the time are resale certificates, manufacturing certificates, and nonprofit certificates. Now, one is an exempt sale, not exempt, and when it's not properly documented. Many states, if you don't properly document an exempt sale, they're not going to recognize it as an exempt sale, and then the tax is going to become due on it. That wasn't always the case. If we went back to, 2007, 2008, 2009, the beginning of the last Great Recession, states were really starved for cash and they had a big need for it. And, they were saying, how can we get more cash? And they looked at some of the laws they had on the books and they said, you know what, we're really not enforcing these rules that we have about certificates. Prior to that time, it was really a matter of form over substance. I mean, substance over form. If the auditor could tell that this was an exempt transaction, they gave you a lot of leeway. But at that time, they changed and it went to form over substance. In other words, if you didn't have every I dotted, if you didn't have every T crossed, then they were going to kick that certificate during an audit. And that has changed. And you think when the economy got better, they'd change back to substance over form. But they didn't. If anything, they've accelerated this because they were so successful. So many companies were not paying attention to certificates and are still not paying attention to certificates because they weren't problems in the past. They are problems now. And this has become the number one issue for companies that are responsible for collecting certificates. Number one issue for large assessments. So even one missing certificate can have a huge impact. I'll give you an example. Audits are done on samples most of the time nowadays. So we were defending an audit. They came to us during the redetermination phase. They had about a $3.5 million audit. Roughly 60% of that was related to certificates. And we found all of the certificates except for one. We tracked them down. And this one certificate was an individual who was going to be selling a heavy piece of earth moving equipment overseas. And no one thought to get a certificate from them. And we could not find this person anywhere. The company couldn't find them anywhere. We even hired a skip tracing company. People track down, bad debts and things like that. They couldn't find them. So this person had disappeared off the face of the earth. And it was an $8,000 worth of tax. The invoice would equate to about $8,000, and no one wants to pay that. However, because audits are done on a sample basis, when this was extrapolated out over the population, it was a $270,000 plus error. That's tremendous. One missing certificate had that big of an impact. Now, the client was happy with us anyway because we did a great job on the audit. We had it down to $15,000 from $3.5 million, except for this. So they're still, paying just under $300,000. But we were not able to get this excluded from the sample because of all of the other work that we had done. We used all our favors and the state just would not exclude this thing, made us keep it in the sample. So because of this one missing certificate, the client did have to pay $300,000, much better than $3.5 million. But even one missing certificate can have a huge impact. And we do a lot of exemption certificate management. And sometimes companies try to override our suggestions. If we say we would not accept this, they say, well, this is a good client. And they think that, by accepting it, they'll only have to pay the tax on the one invoice if they ever get audited. And unfortunately, that's not the case. It has an outsized impact because it's part of a population of a sample. So now, $8,000 worth of tax, that's a lot of tax. Most of you are not going to have it, but you're also going to have more than one invoice, and they add up. All right, so it's not just enough to collect a certificate. Someone's got to be reviewing it for the most common reasons it could be kicked during an audit. And, something we need to talk about is good faith acceptance. If a certificate is on the correct form, if it's completely filled out, if it makes common sense, we're going to talk about common sense a little bit more in a second here. The state's going to generally pursue the issuer if the purchaser was not entitled to the exemption. So they're going to go after the purchaser. However, if you don't have this good faith acceptance, then they're going to go after the seller. So that's why this good faith acceptance is so, so important. Now, some of the common mistakes to avoid, the certificate just has to be completely filled out. This is a Texas certificate, and when we're reviewing certificates, you wouldn't believe how many we see that just have big blank spots on them. So that's a reason for the auditor to kick it. Now, if the auditor kicks it, they can put on their detective's hat. They can start digging in and seeing, if this was real, if they were registered at the time, if you accept it in good faith, which means it's completely filled out, they can't put on their detective's hat. They don't do the digging. So when we talked about common sense, if we look down on the bottom left there, it says description of items to be purchased. And then in the upper right-hand corner, it basically says the type of business that you're in. What do you normally sell? So this is where common sense comes in. If someone tells you they're buying a desk and you're selling them a single desk, and up in the right-hand corner, they say they're a software developer. If we use common sense, does it make sense that they're buying one desk for resale? Probably not. They're not in the business of reselling desks. So we have to use common sense and we have to reject this certificate. If you don't, then when an auditor sees that, they're going to say, hey, you never should have accepted this. We're going to kick this. And all of a sudden, it's a problem for you in the audit. So someone's got to be reviewing these certificates to make sure they're completely filled out, making sure they're on the correct form, and that they make common sense. So other than that, you don't have to put on your detective's hat. In the state of Texas, I mean, you don't have to be checking with the state to make sure that's a valid, number that they put on there. However, you do have to check and make sure that it's 11 digits. If there's 12 digits or 13 digits or 10 digits, that's a reason for it to be kicked. Numbers in Texas have 11 digits, so you have to check to make sure it's 11 digits and exactly 11 digits. All right, so where we see the biggest problems is drop shipping. And we usually get a question, well, Mike, what's drop shipping? And drop shipping is a fulfillment method where the seller doesn't own the inventory or doesn't have the inventory on hand when the sale takes place. Instead, when the seller makes the sale, they're going to turn around, purchase that item from a third party, and then have it shipped directly to the customer. Now, here's an important piece here. The nexus of the customer never determines where tax is collected. It's where the seller has nexus. You don't ask your customers, hey, do you have nexus in the state? Because if you have nexus, I'm going to charge you tax. Remember, we went back. If you have nexus, you must either collect a tax or a certificate in lieu of the tax that's acceptable to the delivery state. So that's what confuses this so much. People look at this as one big transaction, and it's really not. It's two separate transactions. So when you're talking to your drop shipper, they're going to want, if they have Nexus in the ship to state, they're going to want to either collect a tax from you or certificate in lieu of the tax in that delivery state. Now, the 10 most difficult states for drop shipping are up on the screen here. And these are states where under all or some circumstances, you're going to have to be registered, or your client will have to be registered in these states in order to issue a valid certificate. Now, Tennessee was removed as of January 1st of 2022, so it's no longer one of the 10 most difficult states. Illinois, though, was an honorable mention. We've slipped Illinois up into that 10th spot. And Illinois will say that, hey, you can use alternative documentation, which we're going to talk about in a second here. But if you do, then you're subject to additional verification. And that means the state gets to put on their detective's hat. So there's a special registration in Illinois. If the purchaser does not have Nexus, they don't have a responsibility to collect tax, they can register for what's called a resale registration, and they can fill out one of the state-specific certificates, give it to their vendor. The vendor has no problems, they have no problems, and they have no responsibility to collect or remit the tax. But in some states, especially California, California is one of the worst states out there. If you have a sale into California and the vendor has Nexus, not only do they have to collect the tax from you if you can't give them a valid California certificate, they have to collect the tax not on the wholesale price, but the wholesale price plus 10%. So a lot of people get registered voluntarily in California rather than pay all this extra tax to their vendor. So anyway, these are the 10 most difficult states. We have a chart out there, and this is in that Salt Vault. This is in the premium portion of our website. This is a proprietary chart, and it tells you what types of alternative documentation the state will accept, if it will accept anything. So some states accept home state certificates. Some states accept the delivery state certificate with a no nexus statement, or with a home state number. Some states will accept the streamlined sales and use tax multi-jurisdictional certificate. The MTC, that's tough. If you're doing a lot of drop shipping, we don't suggest that you utilize this one because there's so many caveats in it. That's where companies get tripped up a lot, because the state may or may not allow you to use a home state number or something along those lines, and there's no footnotes. It has tons of footnotes on it. None of those footnotes apply to whether you can use a home state number. So that is the chart. It's invaluable if you're doing a lot of drop shipping. Let's look at some examples. This is an example of a delivery state certificate. So if you're delivering something to New York, you can download this off of the internet. You don't have to be registered. You're going to fill it out, the name of the seller, the name of the purchaser. You always want to be checking blanket certificate, especially if you're going to be, I shouldn't say always, but most of the time you're going to want to check blanket certificate, because if you check single use, every time you make a purchase from this same vendor, you're going to have to fill one of these out. And that gets real old for you, gets real old for the vendor. If you do a blanket certificate, so long as it's the same type of purchase, then this one certificate will cover it. So you always want to check the blanket certificate. The purchaser information, that's what they're going to use for the common sense. Then you come down to part 1, and it says to completed by registered New York State vendors. And you're not registered if you don't have Nexus there. So you skip part 1, you go directly to part 2. and you say, I certify that I'm not registered, nor am I required to be registered as a New York State sales tax vendor. And then you tell them where you are registered and you put that number in there, and then you check box number D down below. So there are some states, there are 35 states where you can use some form of alternative documentation, or where you can accept some form of alternative documentation, so long as your customer does not have Nexus. So if you're the retailer, if you have Nexus, you cannot issue alternative documentation. You must issue the state specific. But if you don't have Nexus, you can issue this alternative documentation. It protects you and it protects your vendor. All right, so here's an example of a no Nexus statement. So this is the older form here. There's a newer form, and instead of box 7, you'll be checking box 8. So again, you want to check the blanket exemption certificate that's on that check 1 first line up there. There's a series of boxes that you need to check. You want to check box number 3. It says property will be resold under a license number. You can put NA in there, not applicable if you don't have Nexus in Pennsylvania. Because in the brackets right to the right of that, it says if purchaser does not have a PA sales tax license, include a statement under number 7 explaining why a number is not required. On the new form, it's please include a statement under number 8 explaining why a number is not required. So you go down to box 7 or box 8, and then you say, we have no Nexus in Pennsylvania. And that protects both you and your vendor. So again, these are alternatives. These are not tough states. These are not the 10 tough states that were listed. Here is the example of the streamlined sales tax. And this is really easy. This is again, you don't want to check box 1 for a single purchase. You want to start with number 2. You want to put the purchaser's name and address, the name of the seller's address, and then your type of business, and then the reason for the exemption. So resale is a big one. You can check number G, but there's lots of things on there. And then you go to page 2, and on page 2, it gives you a list of all the companies that, all the states that will accept this certificate. So you can use your home state number here. You can even use your FEIN number. There's a number of different numbers you can use if let's say you're in Oregon, you don't have a sales tax number. So the home state number can work. Your FEIN number can work. In any state where you don't have Nexus, you just put that number, and then you draw a line down to the bottom. So very easy to use. This is the streamlined. We've said before that the MTC certificate is very hard to use because a lot of those footnotes don't tell you whether you can use home state numbers or not. And we see more people getting in trouble with that MTC certificate than anything else when they're doing drop shipping. Now, if you are shipping to fixed places of business, then that MTC certificate works great because everyone's going to have a number if they have a fixed place of business in the state. So only when it comes to drop shipping is that MTC certificate not a great certificate. All right, so for certificate best practices, you got to have a system in place. You got to decide who's going to manage that system. I mean, some people, have the salespeople in charge of collecting. Sometimes that works out well, but I generally see a lot more problems when you have your salespeople responsible for collecting certificates. A lot of salespeople very good, but sometimes they care more about the commission, or maybe they do care about the company, but they don't understand tax. So we see all sorts of certificates, all sorts of documents that have been collected that will not protect you in an audit. So who's going to be in charge of collecting the certificates? Is it the accounts receivable? Is it the credit department? Is it the accounting department? Someone's got to be in charge of collecting. Then once they're collected, who's going to validate? And this is something that can be outsourced. Uh, this is a big part of our business. We do a lot of exemption certificate management, and part of our service is we will validate all the certificates as they come in. Now, some of the software companies out there don't automatically do that. They will store your certificates. They will help you collect the certificates, but they don't automatically validate them. That will be a separate charge. So how do you store the certificates? Believe it or not, in this day and age, some companies still store them in filing cabinets all around the country. You really need to be storing them centrally and digitally. I mean, a lot of things fall through the cracks if you got them spread out all over the universe. And when you need them for an audit, then it's a nightmare to try to get them collected. And also, some certificates expire. And when certificates are expiring, you need to keep them updated. Now, even certificates that don't expire, as a best practice, we say to update them every 3 years. And the reason why is a lot can happen in that 3-year period. I mean, maybe they change entity types. Anything that changes their sales tax account number would invalidate that previous certificate. Maybe they, changed. We had one company, they hadn't had their certificate updated. I think it was in 27 years. And, I'm sure it was valid when it was first issued, but it had been invalidated multiple times over the life. I mean, they moved from Texas to Oklahoma. They still had the Texas certificate on file. It's just, it was a total mess. I mean, you have ownership changes, you have entity changes. I mean, again, a lot can happen. So you want to take a look at them every 3 years or so. All right, Ellie, why don't we do a quick second poll question here?
Absolutely. The question we have is, which of the following is not true? The choices are, even one missing certificate can have a big impact in audit. Certificates are not an important issue for pure wholesales. Drop shipping can complicate certificate issues. Or the nexus of a customer never influences where or when a tax is charged. And Mike, we have mixed answers here. So why don't you go over this and then we can close it out and move forward.
Yeah, this is a little bit of a trick question. It says, which is not true? So number one, even one missing certificate can have a big impact in audit. I gave you an example of that. $8,000 in tax, but because it was part of a sample, it was over $270,000. So that is true. Drop shipping can complicate certificate issues. Yeah, because there's multiple parties involved, and the retailer is often not registered in the state where the product is being shipped. So that definitely complicates issues. And the nexus of a customer never influences when or where tax is charged. It's not the customers whose nexus you need to worry about. It's yours. It's the seller's. The seller must either collect tax or a certificate in lieu of the tax based on the ship to state. So that one there is true. We never ask our customers, hey, do you have nexus in this state? Because if you have nexus, I'm going to charge you tax. It just doesn't matter. You're responsible for collecting the tax, whether they have nexus or not. So the correct answer here is certificates are not an important issue for pure wholesalers. And if we go back, to the 2008, 2009, 2010, and prior to that, yeah, that's probably a true statement. It wasn't an important issue. But since that time, when it's become a matter of form over substance, when every I has to be dotted, where every T has to be crossed, it is an important issue for wholesalers. Wholesalers, states, a lot of states didn't even used to audit them because they said, why should we spend our time here? They don't have taxable sales. But now they're a big target for states because if you don't properly document an exempt sale, the state's not going to recognize it as an exempt sale. So wholesalers have paid lots of money that they don't have to pay over the last 15 years or so because they don't have the correct documentation here. So this is a huge issue for pure wholesalers at this point. All right, so registrations and sales tax return filing. One of the biggest questions we get is when and where should we register? Quickly followed by how should we register? Once registered, how often do we file? And then what are some common issues? So this picture here, though, is something my wife says I resemble when I'm in my heavy thinking mode. What should sellers do? Well, sellers should register wherever they have a nexus. What they sell is taxable. The exposure is material. And we're going to get back to material because that's my comment, not the state's comment. Most states believe you should register from dollar number one. And the marketplace is not collecting. So let's move on to materiality. You know, if the cost of compliance exceeds the back tax plus penalty and interest, does it make sense to file? My answer to that question is no. And in a lot of states, we still have a 200 transaction threshold. You're selling a $5 item. The state says, well, you got 200 transactions. That's $1,000. You owe us $80 if the average sales tax rate is 8%. Well, could you get registered? And some states are going to make you file monthly. Can you register and then file returns for less than $80 a year or at $80? The answer is no. I don't know how, even if you do it yourself. Time is money, opportunity cost. So even if you figure in penalty and interest, I mean, double that. Instead of $80, it's $160. I still don't think that it makes sense to do what the state wants you to do. So everyone always says, well, Mike, what's material to me? I can't tell you what's material to you. I'll give you an example. Coca-Cola, $100,000 to them, that's like a rounding error. But $100,000 to me is a huge sum of money. So each of you or each of your clients needs to determine what is material for them. Remember, this is your own personal threshold. This is not the state threshold. This is what you believe is going to be material for you. One of the first things you look at is risk tolerance. If you can't sleep at night, and we have some clients who come to us and they can't sleep at night, they hear footsteps, then they're going to want to get have a lower personal threshold. And by the way, I can't ever make the math work below 3,000. So I can't tell you what is material. I can tell you what I don't consider to be material. $3,000 in taxable sales per year is to me definitely not material. Now, depending on the state, depending on who your compliant is doing your returns, maybe that number is actually closer to 5,000. So if we look at, 99% of our clients, they have personal thresholds somewhere between 3,000 and 20,000. If we drop that number to 80%, it goes somewhere between 7 to 12,000. That's where most of our clients start looking at this to be material. So, if you're hearing footsteps, maybe you're at $3,001. If you say, Mike, I go to Vegas every week, I never lose. Nothing bad has ever happened to me in my life, and I don't believe that the state's ever going to come looking for me. Maybe use a $20,000 number. Second is profit margins. We work with a lot of companies that say, well, Mike, I'm trying to build my market share here, so we're working with 2% profit margins, or sometimes in this economy they're not even making money. And this is counterintuitive, but these companies are the ones that say, I can't afford to be compliant. And my comment is, you can't afford not to be compliant. You got to remember that most states, an average rate is going to be 8%. Add another 50% to that to penalty and interest. You're looking at a 12% effective liability. you're only making 2%. Not only, if state finds you 3-4 years down the road, not only have you wiped out your profits in that one state, you may have put yourself out of business. And states generally talk to each other, not all states, but you may get a call from 2 or 3 more states. So I look at this as insurance. I've got a bunch of rental houses and some of them are free and clear. And insurance certainly does not add any value to these houses. And I don't think the houses are going to burn down. But what happens if I'm wrong? So to me, the cost of compliance is like the insurance premiums. If something bad does happen, then I'm covered. So the higher your profit margins, you get 100% profit margins, 50% profit margins, you can't afford to take a larger personal threshold. And then capital reserves, you got a lot of money in the bank that's not earmarked for anything, then again, you can have higher personal thresholds. So ways to register. You can register prospectively. You can register historically. You can register through a voluntary disclosure agreement, or you can register and do a managed audit. Now, registering prospectively means that you're choosing a current date or a date in the future and say, I'm going to get registered as of this date. And sometimes that may be what you need to do. Maybe you just crossed the threshold. However, some companies, believe it or not, there's 50 to 60% of companies that are still not compliant for economic nexus. And when they find out, they say, well, I don't want to pay any of that back tax. Let's just register prospectively. And that's not the way the states want you to do it. And that doesn't waive any of your past exposure, but at least it stops the bleeding. So we have a lot of companies do that. There are certain states where you cannot do that. A state like Illinois is going back and they'll let you register that way, but then they're going to audit you, and they're auditing everybody. State like Wisconsin is going back and auditing everybody. So you got to pick and choose. If you're going to take this method, you got to limit your exposure. Some states are not being aggressive in going back and auditing the start dates. Registering historically, that's the way that the state would want you to do it. You give them the date that your nexus actually began, and then you got to pay back taxes plus penalty and interest. You can request a penalty waiver, and most states are going to be pretty good and go ahead and give you that penalty waiver. A voluntary disclosure agreement is a little bit more formal than registering historically. As a reward for stepping forward voluntarily, the state is going to limit your look back period. So in California, you've got an 8-year look back period. Their VDA is 36 months. So right away, you're saving 5 years worth of back tax, penalty, and interest. And not only do they limit the look back period, but for the periods in the VDA, most states generally waive the penalty. And some states like Texas waive 100% of the interest. There's 7 states in total that do something with the interest. So voluntary disclosure agreement is a great tool, but it's not a one-size-fits-all tool. And there's some of the software companies out there. I mean, we have a lot of people come to us and the software company tells them, hey, if you owe more than $500, you need to do a voluntary disclosure agreement. And by the way, we charge $3,500 to do voluntary disclosure agreements. Well, I scratch my head and say, how do these guys sleep in the morning? How do you live with yourself? Why in the world would anyone want to pay $3,500 to remit $500 worth of tax? I guess there are some, if there are criminal penalties involved or something like that, maybe you want to do it. But in general, the answer is that's ludicrous. Why would you do that? A basic rule is you got to be saving at least as much money by doing a VDA, or potentially saving as much money by doing a VDA as the cost of the VDA. I mean, these people come to us with $100,000 invoices to remit $30,000, $40,000, $50,000 worth of tax. That's absolutely ludicrous. I don't know how these software companies can do it. So we actually have a service out there. It's a cost benefit analysis where we'll go through, we'll figure out what you would owe if a state found you, what your penalty, what your interest is, and then what the benefit of doing a VDA is. And if you're not saving enough money, there are other options. Register historically. So you got to make sure the program is right sized for you. Just because someone tells you you need to do a VDA, don't take them at face value. And then, if one of the issues with the VDA is if the state's already contacted you, it's not an option sometimes. So sometimes you'll want to register and then do a managed audit. Managed audit, you're generally going to do when the state knows who you are, you got issues. And because you do the work or have someone like us do the work on your behalf, under the supervision of the state, they don't have to spend as many man hours, and they're generally going to waive penalty and some or all of the interest. So those are the different ways to register. Now, filing frequencies. A lot of people think you get to choose your own filing frequency, and in most states, you do not. Some states are going to set your frequency by statute. In other words, everyone is going to be monthly or everyone's going to be quarterly when they first start out. Some states are going to set it by estimated sales. So if you tell someone that your estimated sales are $2,000 a month, taxable sales, roughly 50% of the states out there are going to put you down as monthly, and some will put you down as quarterly. You want to be fairly accurate because these get reviewed. So after a certain period of time, states are going to review these and change your frequencies. And you don't want to have such a ginormous change in what you told the state and what you're doing that it throws up a red flag. Red flags are bad. The filing frequencies are monthly, quarterly, semi-annual, and annual. Very few states have semi-annual. We're seeing a trend out there of states moving away from quarterly and shifting people to monthly. There's also occasional, and occasional means if you collected tax during the month, then you're supposed to remit it that month. Occasional doesn't mean, hey, I get to file whenever I want. All right, so let's talk about sales tax return filings. So you can do it yourself. That's a big option there. A lot of companies do it themselves. You can hire a third party, and when you're hiring a third party, you got to ask yourself some questions. You have sales tax specialists like us. We do a whole bunch of returns every month. You have your existing accountant and bookkeeper. Some of them have great, SALT practices. Some of them are brand new, and they're listening to the software companies that say, you too can be a sales tax expert. So you got to know how many returns your existing accountant and bookkeeper are doing. Usually they're real good in their home state, maybe some surrounding states, but we're in a multi-state environment now due to Wayfair. So it's hard to stay on top of all of the different states out there. Now, when it comes to software companies, there's really two levels. There's full service software companies like an Avalara or Vertex, and then you have limited service software companies. When I say limited service, they can't do everything that you need them to do. An example of this would be a tax jar that just couldn't file certain types of returns, like the Oklahoma vendors use tax. So you've got to make sure that they have the capabilities to do everything that you need them to do. And when it comes to registrations, by the way, you got to make sure you're registering for the right type of tax. What we're seeing problems right now with Avalara is they have either registered someone for the wrong type of tax, or maybe someone's registered for the right type of tax, but it's not set up correctly inside the system to collect the tax correct. So we're doing a lot of compliance reviews right now to make sure that this is correct, because the state of Illinois is just coming back and they're saying, hey, you should have collected all these local taxes, and now you got to pay out of your own pocket 3 years worth of local tax because it wasn't set up correctly. You're underneath the old rules rather than the new rules, and this is changing all of the time. So you got to make sure Number one, that you're registered correctly. Number two, that the software company you're using, if you're using a software company, can actually do this, everything that you need to do. And here's a fact. You're more likely to be audited for sales tax than you are for income tax. And you're more likely to have bigger issues with sales tax than you are for income tax. And there's a lot more returns that are done. So if you're not utilizing software for income tax, if you're having a professional do that, why would you utilize software for sales tax? The risk is a lot greater. But that's just my opinion. Now, a company like Avalara, they can do everything. The problem with Avalara is they're so big, you just become a number there. And this is what they actually put out. You know, they had a problem with the customer experience. And, you know, you used to be able to talk to someone. They weren't the person actually doing your returns. But you got to talk to somebody who had to go and talk to somebody else, who you generally had to go talk to somebody else, and it got back to you. Now you can't even talk to anybody. I mean, software companies, what do? They create trouble tickets. That was their solution. And if anything, I think that these issues have gotten worse rather than better. So points to consider when you're choosing who to do your returns. How much time do you have to devote? What do you need to do as part of the process? Can the provider file all the returns you need to be filed? Who's your point of contact? With us, the point of contact is going to be the person actually doing your returns. You know, do you have some sort of middleman? Do you have someone who even knows what a return is? Does your provider know the red flags and how to avoid them? What method does the provider use to balance? We use tax collected and gross sales. I mean, sometimes you got to manipulate numbers in order for the state to be ordered to accept them. TaxStar, what they used to do is, and I'm not sure if they're doing this still, they would do a forward calculation. So they didn't really look at what you collected. They said, here's what you should have collected. And all of a sudden, a lot of their customers said, hey, why did we, you know, submit an extra $10,000 worth of tax this year? Well, that's because TaxStar ignored what you were doing and told you you needed to remit this much. So it's really important. What method does the provider use to balance? All right, notice management. What do you have to do? Notice management is a loaded term. I mean, states are not very efficient. They're always going to send out notices. Sometimes it's going to be because something was filed late. Sometimes it's going to be because one hand at the state doesn't know what the other hand is doing. But what do you have to do? Some companies say they have notice management. All they do is collect the notices and say, hey, here's a list of notices for you to solve. You know, there are other companies like us that are actually going to take that notice and actually solve it for you. Bank reconciliation. Who's doing that? Are you responsible for doing it, or does your provider help you with that? Who confirms all the sales tax collected is actually remitted? We have major issues with companies coming to us and saying, hey, they're collecting the tax. You think they would let us know that it's not getting remitted. They're filing our returns. They're filing, you know, consumer use tax returns rather than vendors use tax returns. And we get all this tax collected, not remitted. So who's tracking that? Who's making sure? Who's tracking the messages in the online account? Filing frequency changes, state fees for renewals, general messages. So those are all the things that you need to consider. Now, red flags. Red flags is an issue that draws attention to your account and increases the chance of an audit. Some red flags are a pattern of filing returns late, pattern of filing substantial amounts of exempt sales, returns not balancing what the state expects, and then incorrect forms, incorrect rates, incorrect application of credits, forms completed incorrectly, etc. So these are the red flags. Best practices: keep records of all returns and filing payment confirmations. Keep all records for at least the statute of limitations plus a cushion in case of an audit. Check your accounts periodically to ensure all tax collected is remitted and that you're not paying more tax than you actually collected. And make sure your gross sales match gross sales listed everywhere else. All right, Ellie, let's do the final polling question.
Absolutely. That should be up on everyone's screen right now. True or false? If you are not charged tax by the seller, your purchase is tax-free. And quick reminder, you do have to answer these poll questions in order to receive CPE credit. Mike, most people are answering false here. Actually, everyone's answering false here so far. Do you want to review this one and then we can close it out and move forward?
Yeah, that is 100% false. If the seller doesn't charge you tax, you're supposed to, if it's a taxable sale, you're supposed to self-assess and remit the tax to the state directly as a use tax. All right, so we're going to go very quickly through sales tax audits. And, you know, there's no way to ensure that you're never going to be audited. That's just not possible. However, you can have some great policies in place to avoid large assessments in an audit. And you can also work on limiting the red flags that may increase your chance of an audit. So that's what these 7 pillars are all about. Not that they're going to prevent an audit, but if you do get audited, you know, you're going to limit your exposure. So you got to know what your nexus footprint is. You got to register where appropriate. You got to know if what you sell is taxable. When in doubt, tax. Source sales correctly and charge the best rate you can. Have a use tax system in place. Collect and validate certificates on all exempt sales and make sure your returns balance, all taxes remitted, and you're limiting those red flags. Now, registered companies are chosen for an audit. The biggest way for small to medium-sized companies is by a lottery. It's a lottery you don't want to win. Some companies go their entire existence, never get chosen. Some are not so lucky. Red flags. If you have a lot of red flags, you may be chosen for an audit. Asking for a refund will often cause an audit. Industry issues. If the state sees that a whole industry is doing something wrong, then they will go after the whole industry. And then informants. People can tell on you, employees, competitors, customers, and sometimes they can even be paid bounties for turning you in. Initial steps to take when you're notified of an audit. Number 1, review your pillars. If issues are found, you can consider a managed audit. If you know you got problems, the auditor's probably going to find them, consider a managed audit. Work to correct certificate issues. We often call this XYZ work because California has a process. It's XYZ, and it's for missing certificates. So work to get those issues corrected. Request missing records from customers or vendors. Look for offsets, and then review what the auditor is requesting. Perhaps the most important issue here is auditors have a lot of influence concerning your audit. And while you don't need to be best friends with the auditor, we strongly suggest you have a good working relationship. You don't want to alienate the auditor. They're always going to have the last laugh. And, you know, we hear stories all the time in Texas. We put them out in a trailer with no air conditioning in the middle of August. It was 110 degrees out there. They got out of here quick. Well, guess what? They got out of there quick, and they're going to put air. They're not going to give you the benefit of the doubt anywhere, or freeze them to death up in, you know, Minnesota. You want to have a good working relationship. An auditor can keep a lot of stuff off the schedule. They can, you know, you can play give and get. You know, if there's something that got you dead to rights, give in on it. And maybe you'll get something that's a little bit in a gray area. So you got to have a good working relationship. Best practices for an audit. Set one contact person. You got to have message consistency. That person should have a knowledge of your business, access to records, knowledge of tax policy. Don't assume the auditor is your buddy. Answer questions, but don't volunteer information. Work with the auditor to keep items off the schedule. Don't assume the auditor is right or wrong. Don't be afraid to question the auditor. Ask for documentation of items you don't agree with. And this is really important. There's a lot of new auditors out there. Don't be afraid to ask for the audit supervisor. You can't do it based upon emotion, but if you know you're right, ask to talk to the supervisor. After the audit, have an exit conference, review your assessment. Is it fair? Is there any factual error? Is it worth appealing? Too many times companies, get emotional and they want to fight it, and now they're just throwing good money after bad. If there's a factual error, by all means, appeal. You always want to ask for a penalty waiver. A lot of times, especially if it's your first audit, you'll get it. And then correct any deficiencies. Use it as a learning experience, because other states are going to come by, or you could have future audits. And Ellie, I know we've ran late here, but do we have any questions?
Later, just on time, one of the two, but we no questions, Mike, and we'll call it perfect timing. So
All right.
yeah, thanks everyone for joining us. Please reach out if you have questions or if you'd like to work with us. Mike, anything else you want to add in?
Thanks for joining us today, and look for the individual deep dive into each one of the pillars.
Yes, thank you. Keep an eye out for those, and let me know if you have any questions about those pre-recorded webinars or information on how to register and get involved with that. So
Thank you, everyone.